Guys, I'm curious. What are your thoughts on Affirm's buy now, pay later business? They haven't been around for long, but we've seen some real hype around their services, especially in the current economic environment and with the partnerships they've made with Shopify and Amazon, etc. So the thing is, they've IPO'd at around, let's say, $90 per share, $117 around there at the start of 2021. And we are now down to lows of, let's say, $14 per share. So that's a decline of 80%. Not to mention, we've actually fallen 90% since the highs up there at 160 per share. So it's at this point now that we have to really wonder where we go from here with Affirm. On this channel, we look for value investments. So let's try to analyze Affirm's business to see if now that they are down to all-time lows, if we're undervalued and at a margin of safety, or if we should completely disregard this business. Keep watching to find that out, as we'll be talking about that and more on today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. With that being said, today we're going to take a look at Affirm's Q3 2022 earnings results. We'll do a deep analysis into the financials. We'll then take a look over at the technical setups, and as you can see, down 90% from these highs back in November of 2021. And we'll actually look to see what's setting up here, and then we'll conclude with an evaluation of this business to see whether or not this is something we as retail investors should add to our portfolios now that it's cheap. And if you enjoy the analysis and the value investing perspective, please like and consider subscribing for more of this content. So as always, guys, let's take a look at the technical setups first before jumping into earnings highlights and then results. So on the screen here, we can see that we've declined 90% since November 2021, as we previously stated. Now, without using any of our drawings so far, this doesn't paint a great picture for investors or potential investors. But now let's add on our drawings to see what has actually happened over the last year or so. So what do we see here now that we've added on the drawings? Okay, we IPO'd, let's say at around $90 per share. We then rose up to, highs of $150 per share. Then we're sharply declined back into what we consider our buy zone, which is down here at around 60, let's say $70 per share to $50 per share. And we then had a strong increase in price back up to all-time highs of $170 per share. And that is our strong key resistance zone, which we then found ourselves all the way back down at these now all-time lows. We made it down to even as low as $14 per share, guys. So we ripped right through our buy zone down here. Some people might have got faked out by this move thinking that it was going to go higher. It reversed and went right back lower. So again, we're back into a bad spot for Affirm. And if you watched our Coinbase video, the charts almost look exactly the same. So without even looking at the fundamentals, at the earnings releases, anything like that, you can already tell their underlying businesses are probably going to be in line. We're going to see some bad bottom line results without even looking at those fundamentals. So yeah, that's the technical analysis, guys. Where do we go from here? Post market, we are actually up to $23. This is now going to be our key resistance level here, which is going to be $50 per share. So we're going to want to see, can Affirm get above this level? If it can, it needs to stabilize here and head higher. But this is going to be key. If we can get above $50 per share, this is going to be really, really interesting, especially from a buyer's point of view. But with that being said, guys, let's jump into the earnings highlights here and see what Affirm Holdings did for their Q3 2022 results. All right, so let's jump right into the revenue here, guys, for their Q3 results. They came in at $350 million in revenue. This is actually an increase of about 54% year over year, which is extremely strong. Okay, they also beat analyst expectations by about $11 million. So far, so good for Affirm. Okay, let's look at their bottom line here. Earnings per share came in at negative 19 cents. They still beat analyst expectations by about 37 cents. So while we did lose money for this quarter, we are beating analyst expectations, and that's actually a positive sign because, again, like I mentioned earlier in the video, this is a brand new business. It's only a few years old. So it's not uncommon to see many businesses fighting with profitability as they're brand new. What you really are going to want to look for is, as this business matures, can we fight our way into profitability and then maintain that profitability quarter over quarter over quarter. Anyways, let's jump into the highlights here, guys. Gross merchandise volume increases 73% to 3.9 billion. Total revenue grows by 54%, like we already mentioned. Okay. They plan to achieve sustained operating income profitability by the end of fiscal year 2023. So what they're saying is by 2023, by the end of the year, effectively, a year and 3 months from now, they're going to be profitable. And so we have to see, can they be sustained as they say in their profitability metrics? We'll see about that. Their outlook for the rest of the year and for the whole year for 2022 is that they're going to come in around, $1.3 to $1.34 billion in revenue, and that's in line with estimates. So guys, let's go ahead and jump into the financials now, and then we can conclude with the valuation of this business based on those financials. All right, so starting with our consolidated statement of operations here, we can look at the 3 months this past quarter, or we can look at the 9 months. And because I like to analyze the businesses as a whole, I'm just going to take a look at their 9 months. And we're just going to compare that to the 9 months ending March 31st of 2021. Okay. So as we can see here, $290 million 1 year ago. Now we actually jumped up to $340 million in our merchant network revenue. Okay, that's actually pretty strong so far, guys. Let's continue. Again, we have to keep in mind, we already know they have increased 50% year over year in the revenue side. So top line is growing. And guys, I'm not going to go through all these numbers. You can read them yourselves here. We have seen some strong growth in revenues. And so we got from 608 total revenue to 985, almost $1 billion in revenue just for the 9 months ending March 31st in 2022. Now, the interesting part is what we're going to see in the operating expenses here. So guys, as you can expect from this new business, and I always preach this, when we see businesses that are new, expect their expenses to continuously increase. And that's what we see here for Affirm. Okay, across the board, massive growth here. We essentially doubled here from, let's say, 800 million last year to 1.6 billion this year. For this first 9 months. So guys, it is what you can expect. You'd want to see the revenue to be able to grow a little more if we're going to grow our expenses by that much, but it is what it is. It results in our operating loss here, let's say $600 million, and ultimately our net loss figure down here once we add back our other expenses, and we get to $520 million in loss. Now, this has grown from last year, $317 million. Not the best thing to see, but again, we are a new business growing here. This is kind of what you would expect. Now, guys, let's jump into the balance sheet really quickly, and we'll start with our cash position, and then we'll move on to the debt. Okay, cash, we can see we've actually grown about $1 billion in cash, which is strong. They're now sitting at about $2.2 billion in cash. They also have restricted cash. Of course, guys, they do deal with credit here with their buy now, pay later business. So we're going to see that also in both the liabilities and assets section. So we have a total of $7 billion worth of assets. This is up from about $5 billion last year. So that's good. Let's move down to the debt serviceability because this is the most important thing for me. Okay, so we see we have funding debt and convertible senior notes. Okay, so let's add these two figures together. So we have 1.7 plus about 9. Let's give it about $2.7 billion worth in debt. And as you can see, guys, we have about $2.2 billion in cash. We do have restricted cash, some other things. All things considered, it's relatively serviceable, guys, here. It really looks like the debt shouldn't be an issue going forward. I do also see here they have notes issued by a securitization trust of 1.5 billion as well. So if we add that on, it makes me a little more cautious about this business. This doesn't mean that you don't invest in businesses that can't service their debt with the cash that they have on hand. It just means that you have to be very mindful of the fact that they do have overhead debt sitting there that they do owe to other people. That being said, guys, let's move on to the cash flow statement here so we can actually evaluate this business and see what this business is truly worth. So if we move down here, statement of cash flows, perfect. So now we see for the 9 months, again, we're going to use this figure here. We're starting here with the $500 million net loss. Okay, we add back in a provision for credit losses, amortization, depreciation, stock-based comp, etc., etc. We get down to a figure here of $103 million in operating cash outflow. This is actually a little better than what we saw last year, which was $173 million. So we're getting closer to that positive operating cash flow figure. But with that being said, there isn't much we can do with that in terms of our valuation here. We're going to have to estimate the intrinsic value of this business once we get over to the calculator. But let's just see what they did with their investing and financing activities here. And what do we see? They were servicing some loans. And if we go to the financing activities down here, as you could expect, they were taking on some debt. All right, guys. So with that, let's go evaluate this business from an intrinsic value perspective. So whenever we struggle to pull a metric to use for their valuation, we'll come over here to look at their historical results. But as you can see, guys, here, again, we don't have any positive figures to evaluate this business on. So it's purely going to be about speculation with the firm. So with that being said, let's try to pull some numbers here, guys. So using their net income figure here, they did mention, again, that in 2023, the end of the year, they expect to become profitable. And from that point onwards, they expect to sustain that profitability. So assuming they can grow their revenues at 50% currently, on a year-over-year basis, that will probably trickle down to their net income figure growing on a year-over-year basis of, let's say, 15 to 20%. So based on that, let's head over to our calculator here. And for Affirm, let's say their net income figure here, they can achieve, let's say, even just $1 billion in net income by the end of 2023 with a 10% required return. They won't be paying a dividend by then, I don't imagine. We can assume that they're going to be growing, like we said, at 15 to 20%. So let's say 15, and then they can grow at 15% again for the next 5 years after that on a 20 PE. We'd be looking at about a $30 billion valuation on this business. Now, if we scroll over here, we can see the actual valuation currently is $4 billion. So it's really cheap right now, guys. It's very cheap with massive potential upside at a market cap of $4 billion. And if we look at this from our exuberant case here, let's say they can grow their net income at 20% for the first 5 years, 15% after that. Yeah, 46 billion now in terms of the valuation for this business. So the upside is pretty strong for Affirm, but you kind of got to wait until at least 2023 to see if they can actually achieve this profitability, and then they'll need to sustain it. So for you speculators out there, this could potentially be a great investment for you if you want to jump in there ahead of the game before they turn profitable. But for us value investors, I don't know if this is something that I would be pulling the trigger on myself, but it definitely depends on what you have allocated for your portfolio, especially if you have a segment of your portfolio sectioned off for speculation. This might be a potential investment, but always do your own due diligence. And actually, I just noticed this as well. In our worst case scenario, which effectively means our margin of safety valuation, if a firm is able to grow to $1 billion in net income with 7% growth the first 5 years, 5% after that for the next 5 years on a 15 PE, we'd be sitting at a valuation of $10 billion, almost $11 billion. We're currently sitting at $4 billion, which means we are within our margin of safety for a potential buy. But again, we have to remember, this is all speculation. They may only get to, $500 million in net income. And at that point, they'd still be a potential margin of safety investment from these current levels, but you never know. They may never become profitable, and this business could capitulate. It could go bankrupt. You don't know. So that's the problem with investing before profitability and speculating. So with that being said, guys, that is the analysis for Affirm Holdings. If you enjoyed the analysis and the investing perspective, please like and consider subscribing, and I'll catch you on the next one.